Hello class, and welcome to this first video on what I think is going to be one of the most challenging topics to cover from a remote standpoint. We're going to talk about accounting for income taxes. Um, Accounting for income taxes on the simplest level, and some of the examples we're going to see, are very straightforward and very simple, but they can become very, very complicated also, okay? The reason why is because tax laws versus generally accepted accounting principles. For those of you that have taken the tax class, you already know some of this, but sometimes tax laws and GAAP don't exactly add up together. Okay, there's some things that tax laws use on more of a cash basis, okay? Or they give you extra expenses that maybe you don't get to take on your income statement. So your net income is never going to equal what the government says your net income is, or what we're going to consider in this class, your taxable income. So that's what we remember if we considered our gross income in tax class. Okay, so that's what we're going to be looking here is how to reconcile the differences between what is reported as net income on the income statement and what is reported as taxable income to the government. Okay. The reason that there are some differences in there is based on those laws. There's two types of differences. There are permanent differences and then there are temporary differences. Permanent differences are just that. They are things that will never change. They happen once, and then after that year is over, okay, you're going to make an adjustment for this for income tax purposes, but it's, how should I say this? It's never going to reverse. It's never going to bring itself back. So I haven't talked about deferred tax liabilities and deferred tax assets yet, but permanent differences will never create any of those. Okay, it is one when the government says some things are not allowed or are allowed that are not allowed under GAAP. Examples of this are um, tax-free income. Okay, if you get interest from municipality bonds, you do not have to pay taxes on that. But yet, for financial reporting purposes, you are going to count that as income. Okay, so that is going to be a difference between net income and taxable income that we are going to have to take out, but it is never going to reverse. And another example that would be fines and penalties. Okay, fines and penalties are you can expense them on the income statement, but we are not allowed to use them as expenses for taxable purposes. They stay part of taxable income. Okay, if you look at slide 50 on the PowerPoint, it gives all the examples of those, and they are also given in your book. It'd be a good idea just to look them over and refresh your mind if you have taken tax class on what those permanent and temporary differences, or what those permanent differences are. Okay, so temporary differences, on the other hand, are ones where it's just a timing issue. Okay, it is not a matter of if they are going to get taxed, because the events that occur are going to affect taxes in one way or another. It is a matter of when they are going to get taxed. Temporary difference create DTLs, which are deferred tax liabilities. Deferred tax liabilities, basically something where we pay in advance. Okay, our taxable income will be greater, or yes, taxable income is greater than our net income for deferred tax liabilities. And so we're paying tax on income that we have not recognized yet on the income statement. So in the future, we're going to have those expenses on the income statement, but we will not have that expense on the tax return. Okay, that's kind of an example of how that would work. On the other hand, DTAs are deferred tax assets. That is when our net income is higher than our taxable income. You know what? I put those up there backwards. Correct what I just said, because I thought while I was saying it, it sounded funny, and I'm not going to stop and restart this video because this is going to be a decent sized one. Here, for deferred tax liability, your net income is going to be higher than your taxable income and just the opposite for deferred tax assets. Okay. An example of this. Okay, so I have written over here, what is recognized on the income statement now, okay, but for tax purposes, you recognize it later. Installment sales. When you have something paid on over a 3-year period, okay, for GAAP reporting purposes, when that contract is signed and it's installment sales, you are allowed to recognize all that revenue at that point in time. On the other hand, for tax purposes, you're not allowed to recognize the income until it actually gets received in cash. So if you had a contract for installment sales of 100 million signed in year 1, you recognize it as revenue, but they paid you 50 million in year 2 and 50 million in year 3. For tax purposes, you will not have any taxable income until year 2 or year 3. So in your first year, your net income will be higher than your taxable income. And when you sign that contract for 100 million, we'll go through an example of this. So that creates a deferred tax liability. You're going to have to pay taxes on some. When you receive that cash, you're not going to count it as income, but yet that is when you're going to have to pay taxes on it. So you have to pay taxes on something you've already counted as income in the future. Same is true for unrealized gains that we just went through with the fair value adjustments and that sort of thing, and the pension benefit, PBOs and stuff. All those are unrealized gains. Okay. As far as creating deferred tax assets, okay, that is recognized on the income statement now, but tax purposes later. Contingent expenses. So that, I believe that was back at the end of last semester, the last year we did, we talked about contingent expenses. So those are things that may or may not happen that we estimate a lot. The warranty expenses, okay, the lawsuits, the asset retirement obligations, those type of things we put on the income statement as expenses, but for tax purposes, we're not allowed to expense them until they are actually paid. So that's why it's on the income statement now, but not taxed until later. So that is going to actually, since we're not allowed to take those expenses, make our taxable income higher than our net income and creates a deferred tax asset. So basically, we are paying taxes now on on income we have not earned on our financial statement. Okay, and it's the same thing. Unrealized losses fit into that. Things now, okay, stuff that is allowed to be taxed now, allowed for tax purposes, but the income statement has to allow it later. Accelerated depreciation. Think of bonus depreciation, section 179. The government allows you bought a $60,000 piece of equipment. The government's going to allow you to depreciate that $60,000 piece of equipment and count it as an expense all in the first year. But maybe for financial reporting purposes, you want to do a straight line over a 6-year period. So you're going to expense it $10,000 a year. Okay? $60,000 taxable expense compared to a $10,000 income expense is going to make your net income higher than your taxable income. So accelerated depreciation is a deferred tax liability. Okay. Same goes with prepaid expenses. When you pay the money, it is not going to be an expense it's going to go as an asset onto the financial statements, right, as a prepaid expense. But prepaid expenses is cash going out for an expense. For tax purposes, it looks like an expense, so you have to count it as an expense. You have more expenses, it lowers your taxable income, allowing your net income to be higher. Again, creating a deferred tax liability. Along the same lines with the prepaid expenses is unearned revenue. Unearned revenue is a liability on the financial statements, but for tax purposes, when you receive the cash, that is counted as revenue. Okay, so that will make your taxable income higher than what it is on your net income for the time being. Like I said, all these temporary differences will reverse out, but that creates a deferred tax asset. Okay. This chart, remembering what creates a deferred tax asset and what creates a deferred tax liability, along with the permanent differences, is the key challenge to this class, okay? So my suggestion is when you're doing the homework, you're working on the test, whatever, keep a note card beside you with what creates a deferred tax liability and what creates a deferred tax asset. Here, let me erase this now. To account for income taxes, we are going to go through a 4-step process. First, we're going to calculate income tax payable. ITP. Okay. This is always the first step because it is based on taxable income. Okay, because I say we calculate income tax payable. To find our income tax payable, it will be taxable income times the tax rate. Okay, I'm going to show you how you guys how I'm going to abbreviate these moving forward so I can save room on my board. Okay, income tax payable will always be ITP. Tax rate is always going to be TR. Taxable income, TI. Okay, so step number 1, calculate income tax payable. Taxable income times the tax rate. But to find taxable income equals net income plus minus find our taxable income. We start with our net income. The first thing you do is you add or subtract any permanent differences out of it, and then we add or subtract any temporary differences from that. There. That is your taxable income multiplied by your tax rate equals your income tax payable. Step number 2. Step number 2 is we have to calculate the ending deferred tax asset or deferred tax liability. Okay, keys to this one. You can combine all deferred tax assets together, and you can combine all deferred tax liabilities together, but you cannot combine deferred tax assets with deferred tax liabilities. Okay, so however you classify them right at the beginning, it is always going to be a deferred tax asset that will reverse or a deferred tax liability. They have their own categories and they will never combine to offset each other. Okay. I don't want to say this. This is because based off the original dollar amounts. Okay. So if we had, like, I'll go back to my example here where we had 60,000 depreciation that we were going to do over 10 years of 10,000 each. Okay. So we'd have 60,000 expense the first year, but for income tax purposes, we'd only have 10,000. So we would have a $50,000 difference. Okay. So for the first year, it's based on our original dollar amounts. We'd have a $50,000 deferred tax liability at this time. We would multiply that by the tax rate, and that is our actual deferred tax liability. Okay, so when I say it should be We have a 50,000 amount of income that we have to pay taxes on later, multiplied by the tax rate gives us our deferred tax liability. The next year when it comes along, we had a $50,000 tax liability. We're going to expense 10,000 more, so it's going to reduce that liability down to 40,000, but that's not the amount we use in calculating our ending number. We would multiply the 40,000 now, the ending dollar amount that we still have to pay taxes on, multiplied by the tax rate. Okay, and hopefully if we work through some problems, this will help make sense. But it's in between this step and the next step where some students get confused and where I think it's kind of the most difficult, because we have to go back to the original dollar amounts, multiply it by the tax rate to find the ending deferred tax asset, deferred tax liability. Step 3, we calculate the change in the deferred tax asset or the deferred tax liability. So once we found the change in the dollar amounts, multiplied it by the tax rate to find our ending deferred tax asset, deferred tax liability, to calculate the change, and you do that with a simple T analysis, okay? So we calculated the ending, and we say it's supposed to be 5. We currently have 15 in there. So when we go to make our journal entry, as you can see, it is going to be that one over there. Yeah. Step number 4, plug income tax expense. Okay. Anytime we're going to do a tax entry, we're going to have this journal entry. Income tax payable. We calculated in step 1. We found our taxable income. We multiply it by the tax rate. So we're going to say our income tax payable was 20. Just for income. Okay. Calculate the change in deferred tax assets or deferred tax liability. So we went through, we found the ending. We found the change in our dollar amount, multiplied it by our current tax rate. That is what our current ending deferred tax asset, deferred tax liability is. We went to our general ledger, we plugged it into a T account as the ending balance. We looked at our beginning balance, found the adjusting entry that needed to be made. The adjusting entry is what we are going to make here. So for our problem, we're going to say deferred tax liability went up 5, deferred tax assets went up 4. Our final is to plug the income tax expense in. It is just a plug number. So we would show income tax of 21 on the income statement for this year. So that is how that number is calculated. It's a very interesting study when we get to going through some problems with these, and we're going to look at it. It just brings to mind when so many people look at income statements and say companies aren't paying their fair share of taxes, their income tax expense was 0, blah, blah, blah. You know, maybe they don't quite really understand these deferred tax assets and these deferred tax liabilities. Okay, and as you see, not in this video, but when we get into some of the more advanced videos, especially with the Tax Cuts and Job Act that I went through, it made a big difference on a lot of companies' income statements. Okay, the income tax expense got affected big time because of the adjustments that we are going to make to those accounts. Okay, so let's work through a couple simple problems of deferred tax liabilities before we end this video, and hopefully we'll try to make these concepts here make sense. But we're going to go through these 4 steps here in this problem. So we're going to look at a company over 3 years. Here's some information. For 3 years, this company, for each of the 3 years, reported $100,000 of net income each of the 3 years. Okay. Beginning of year, in year one, they bought a $60,000 piece of equipment. Section 179 bonus depreciation allows them to expense it all in year one, but for financial reporting purposes, they are electing to do a 3-year straight line depreciation, and there is no salvage value on this equipment. So they're going to depreciate it at a rate of $20,000 a year for 3 years. Okay. So, step one, find taxable income or income tax payable. In year one, we have a net income of $100,000. There is no permanent difference. We're going to need to subtract out the temporary difference. Okay, we have depreciation. Depreciations create a deferred tax liability because it is going to lower our taxable income from our net income. But what is the amount of the temporary difference? Well, for net income, it's 100 minus 20 for 80,000. For taxable income, it's 100 minus 60 for 40,000. So we have a difference of $40,000. Okay, that is our temporary difference dollar amount. So our taxable income for the year is $60,000. It gives us that our tax rate equals 25%. 60,000 times the 25%. Okay, 15. What is it? Okay. My book, I'm writing that on here, so we'll put out there 15,000 because it took down the last 3 numbers, so we'll get me confused from there. That is our income tax payable. So that was step one right there. Okay, step one, find our income tax payable. Step two, we find our ending DTL. You know, as a deferred tax liability because it's depreciation. The dollar amount that's in that right now is 40,000, right? We just created it. We made this 40,000. What we do times 25% for 10,000. Okay. There is no adjustment to be made for step 3 because we have no beginning balance. Okay. So that is going to be the adjusting entry to create the original deferred tax liability. So we have an income tax payable of 15,000, a deferred tax liability of 10,000. We do not have a deferred tax asset. We go to step 4, we plug the last number. Income tax expense of $25,000 reported on the income statement for the period. Okay, but they're only actually paying $15,000. Okay. So that is year one. That is year one's journal entry of how you would account for it. So it's asking how much is the income tax expense. for the year, 25,000. Income tax payable, 15,000. Move on to year 2. In year 2, we start with our 100,000 income. This time, our deferred tax liability is now reversing itself out. Okay. So to get from our net income, if I do this again to illustrate it, our taxable income should actually be $20,000 higher than our net income, because we are still going to take the straight line depreciation out on net income purposes. But for tax reporting purposes, we've already expensed it all, so we're not allowed to expense it again, makes our income higher. It's just reversing out that difference. So it was a $40,000 difference that we already started with. Well, here we're reversing out 20,000 of it. We need to add $20,000 to our income, making our taxable income $120,000 times 25%, getting us an income tax payable of $30,000. Okay, so that is step 1. Here, I'm just going to go ahead and start plugging this in down here. Lose it, $30,000. For step 2, our ending DTL, the ending dollar amount that's in our deferred tax liability is started at $40,000. We just reversed 20,000 of it out. Okay, we are left with a $20,000 amount that still needs to be reversed out due to the depreciation going to be reversed. So we multiply that by our tax rate of 25%. And we get 5,000. Okay. Step 3, we plug it into our T accounts. We started with a 10,000. We need to end with a 5,000. So we are going to do a $5,000 debit entry when we go to make this adjustment. Deferred tax liability is 5,000. You make a plug-in number, you fill out your income tax expense for step number 4, and your income tax expense becomes $25,000. Okay. I'm not going to go through year 3 because there's only $20,000 left in it. It reverses out itself again. We're going to have 5,000 at the top. You're going to find out that you no longer have a deferred tax liability. It's going to be the exact same journal entry. Okay, because $20,000 is going to get added to your net income for the last temporary difference reversal, still multiplied by the tax percent. All right. Move on and show one more example of a deferred tax liability. I want to put it with you on installment sales. Okay, our tax rate is still 25%. In this one, we reported revenues of 180 in year 1, 100 in year 2, and 100 in year 3. But additional information we're given. Year 1 includes 80 of installment sales. That. And they're received this way. 20 of it gets paid in year 2, and 60 of it gets paid in year 3. For financial reporting purposes, we're allowed to recognize it as revenue, that whole 80 here in year 1 for the installment sales. For tax purposes, we are going to have to recognize it whenever we get it, so it's something we have to pay in the future. It's going to make our taxable income lower than our net income right now, which is a deferred tax liability. You forget that to walk through that process, have that chart written out on what creates deferred tax assets and deferred tax liabilities, and you'll see installment sales fall into the deferred tax liability category. When we have a deferred tax liability, it is always going to reduce our net income to our taxable income. So if we're lowering our revenues here, we did not receive any of the cash, we have to lower it by 80. Our taxable income now becomes 100 times the same tax rate to get an income tax payable of 25. Step 2, our temporary difference is 80 times our tax rate of 25% equals 20. We do not need to do step 3 because it is the first one of the bunch. We know that's what it needs to be. It's a DTL of 20, income tax expense of 45. In year 2, you see that we received 20 of the installment sales. So we're going to reverse out 20 of that. So it's 120 times 25% gets us 30 for the income tax payable, okay? Net income plus the temporary difference that is reversing out. It was normally a negative 80. We are adding 20 back to it because we received it. So that is the reversal of the temporary difference, makes our taxable income 120 multiplied by the tax rate to get our income tax payable of 30. So now we find our ending ETL. Remember, it started out, it was 80,000, but we reversed 20, so we are looking at 60,000 times the tax rate, which gives us an ending balance of 15. We plug that into our deferred tax liability account. We started it at, make sure I get the right number here. We started it at 20, lowered it to 15, so we need an adjusting entry of 5. Plug in income tax expense as the last step. And there is your year 2 journal entry. 25 income tax expense, 5 deferred tax liability, and an income tax payable of 30. Finally, year 3, they get the final 60, same process. We get 160 for taxable income on this year. 160 times the 25% tax rate. It's income tax payable of 40. It has all been reversed out, so 0 times 25% equals 0, right? There was 60 left in there, about 60,000 or $60. Took out the 60, it's finally all reversed. We'll go to our T account here. We did have a 15 up there as our beginning balance, 20 minus the 5 we did in year 2. That needs to be 0. There's our adjusting entry, deferred tax liability of 15. And an income tax expense of 25. All right. So there are some straightforward, simple examples of working through deferred tax liabilities, a couple on installment sales, so the revenues and the expense side. In the next video, I'll work through some deferred tax assets, and then there are some deeper issues that we'll also get into with assets and valuation accounts. And sometimes you might have a deferred tax asset you may not get to realize for some reason or another, but we'll talk more about that in the next video. All right, so as always, I know this is difficult. Reach out to me if you have any questions. I'm going to have this chapter homework assigned shortly. And I also want to let you know here at the end of this video that we're going to change the class structure a little bit. I know we were supposed to have a test coming up, but I'm just going to wait and put everything into one final test. I think it'll be easier that way. I'll be able to a little bit more material, but it'll allow me to make more questions, and you'll have your books and your notes since you're doing it at home. It won't be real difficult. I just think it's going to be beneficial for everyone that way. So good luck with this, and please do not be shy. Reach out to me if you need anything. Thanks.